from Bollinger Bands. Now, Bollinger Bands were created by legendary money manager and researcher John Bollinger. Bollinger Bands are one of the most popular indicators applied by traders throughout the world in nearly all markets. It's rare today to see a chart not accompanied by Bollinger Bands, and they become a must-have visualization tool which allows traders to see how overbought and oversold a security is. Now, it's said that everything you need to know and do to make a trade is contained within the bands of Bollinger Bands. Now, the fact is there's an abundance of information on Bollinger Bands. Most of it, though, are gurus trying to convince you how to use their system. But the nice thing about Bollinger Bands is John Bollinger is still an active analyst, and he has his own website, which is just www.bollingerbands.com, and you can learn from the master, the man who invented it and developed it and who's tested it for over 30 years. Now, we're going to look at Bollinger Bands in a bit, and also the newest part of Bollinger Bands, which has been around for about 10 years now, which was developed as he changed everything to fit the online trading world. But we'll also be looking at percent B. But Bollinger Bands is made up of 3 simple lines: a lower band and an upper band, and a simple moving average moving between it. Now, that's not to say that these upper and lower bands are easy to calculate, because they're done with a mathematical formula that's quite involved. But you'll never have to calculate it because it's dropped on the charts for you, but it uses something called standard deviation. Now, Bollinger Bands can be applied in all the financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short-term periods to hourly, daily, weekly, and monthly. So for all of us that are here with ETX, we're CFD traders, and we're opening and closing positions usually within a day. And most times trading in short-term markets. And Bollinger Bands quickly adjusts. So therefore, they work very well in forex markets as well as fast-moving markets. Now, Bollinger Bands answers one very important question: are prices high or low on the relative value? Because if prices are high on a relative value, we may not want to buy into that. If prices are too low on a relative basis, we might not want to sell into that. But by definition, price is high at the upper band of the Bollinger Bands and price is low at the lower band. That bit of information is incredibly valuable. It's even more powerful combined with other tools such as other indicators for confirmation. Now, Bollinger Bands are a technical analysis tool. Specifically, they are either trading bands, or you can call them envelopes. Trading bands or envelopes serve the same purpose. They provide relative definition of high and low. Now, interesting, in the real world, Bollinger Bands is based on what's called standard deviation, and it uses a 2 time period standard deviation. So the upper and the lower band are calculated by using the moving average and then applying a 2 times standard deviation plus and 2 times standard deviation minus. Okay. Now, standard deviation is a big mathematical word. And interesting enough, in the real world, no statistician would ever calculate standard deviation by hand. This calculation involved are somewhat complex, and the risk of making a mistake are high. So even a mathematician isn't going to calculate this. So we use computers, and they just drop the bands on the computer for us. But to give you an understanding of standard deviation, standard deviation is calculated based on the mean. The mean is like an average. The distance of each data point from the mean is squared, then summed, and then averaged to find the variance. Okay, do you understand that? I don't understand it. Or to put it another way, variance is derived by taking the mean of the data points, subtracting the mean of each data point individually, squaring each of these results, and then taking another mean of those squared. Standard deviation is simply the square root of the variance. Okay, a lot of mathematics, a lot of formulas in there. But in the simplest form, the mean is simply the average of all the data points in a given set. In investing, for example, you might want to know what the mean closing price for the last 20 days. Or what do we call that? The moving average for the last 20 days. This can be obtained by adding the closing prices for each session, dividing by 20. Because the markets are fickle at best, traders and analysts use moving averages to adjust daily to incorporate the most updated data. This means the calculator is always taking into account the most recent session's movements, and the older sessions drop off as they're less relevant. And in this case, we use an exponential moving average, which is calculated by a weight added to each data point, giving more value to the most recent data. And then from there, we take that mean and calculate the standard deviation. Okay. So by default, Bollinger Bands are set to a 2 standard deviation. However, if you want something less sensitive, you can adjust it to a 2.5. But don't do this until you understand how to use Bollinger Bands correct. With the 2.5 standard deviation, 99% of all the price action will fall between the two bands, which means that a violation of the outer bands becomes a much more meaningful signal. Okay, so you had lots of words. Let's go over and let's see Bollinger Bands on a real chart. So let me pop up some charts for you. Okay, and as soon as it pops up on your screen, hold on, it's taking a second too long here. Give me 1 second here. I'm just refreshing my screen for you guys. Okay, hopefully it popped up there for you now, fine. So we've added, I've already added for you. So we're looking at a chart of gold right here. This is the current chart of gold. I went up to the indicator up here and then located Bollinger Bands and clicked on Bollinger Bands and had them drop in the chart. But for class, I've done that a little bit ahead of time because I wanted to color them so that you could see them a little bit better in class. So what you can see is the 2 green, dark green bands right here and right here. These are the upper and the lower band of the Bollinger Bands. This is the moving average band, the 20-period moving average band. And the shaded area is just the inside the band, and this shaded area inside doesn't tell you anything. We look at the outer band and the upper band, but the width of this band or this envelope also tells you how volatile the markets are. The wider the bands, the more volatile the market is. The more contracted the bands are, the more contracted the market is, or the less volatile it is. Now, as you can see here, when I put Bollinger Bands on here and I use them format, our inputs are a 20 length period for a moving average. We use the close and a standard deviation of 2. This is the standard default for Bollinger Bands. So when you read all the material, you go to Bollinger Band site and you read all the material. It's all based on what we call 220 Bollinger Bands. Now, again, if you adjust the period, the standard deviation 2.5, it moves that standard deviation from 2 widths away to 2.5 widths away from the moving average. And it would contain all the price movement and give you less signals, but more valuable signals. But because that is a customization as opposed to a standardization, it requires you to also adjust the literature or do some of your own testing. So I recommend everybody start out with the standard 220 standard deviation. Okay. Now, what we can see is, and Bollinger Bands is one of the few indicators that's actually dropped over price on the chart. Most indicators are put below the chart and are located on their own little charts below. Bollinger Bands has actually dropped right over top of the price. Now, when price, it said, when price is approaching the upper band or violates the upper band on a relative basis, that price is high. When price is down at the lower band or breaks through the lower, price on a relative value is very, very low. Now, when it breaks an upper band or a lower band, it is said to give you a buy or a sell signal. But it's not that simple. We need a little bit more information than that. It's also said that when the price falls below the moving average or breaks above the moving average and is moving towards the upper band, it should be a bought. If price breaks through and falls towards the lower band, it should be sold. We also have what we call riding the bands, where price stays right at the relative value of the bands. All of these are telling you something about price. So this is what Bollinger Bands looks like on a chart. Basically, it's pretty simple. It's interpreting what you're seeing here. So let's go back to my PowerPoint. Let's try interpreting this a wee little bit. So remember, the base or the lower band, or the base, is the moving average, which is based on a 20 base. The moving average is usually a 20-period moving average. The upper band spreads above the moving average by a volatility measure known as standard deviation, set at a 2 standard deviation. So as you can see on this chart, it's still the same as it was on my charts. Now, these bands give you 3 pieces of valuable information, or 3 ways that you can use them. One is through pattern recognition, which are known as double tops or double bottoms, or for Bollinger Bands called M's and W's. Then it gives us reversal signals, telling us the trend is about to reverse, and it also gives us trend analysis, and it will detect continuations or conclusions of the trend. But before we can look into these things and add on the next step, which is the newest part, is %B, we first have to understand how to take the first bite out of the apple. So one of the simplest ways to use Bollinger Bands, and one of the less stressful, because it takes quite some time, is to locate patterns. And there's only 2 patterns we're going to locate. It's called an M or a W. Now, the fact is, as you can see on this chart over here, this is the formation of a W. But it takes a lot of candlesticks. It takes a lot of time for this formation. It's like forming a head and shoulders in a regular chart. It takes a lot to complete the entire pattern. So we don't need to notice it. We don't even need to realize it's even happening until we see what's called the formation of the N, or the upside down N. So what we see is we see leg number 1, leg number 2, leg number 3. When leg number 1 and leg number 3 bounce back at the same bottom, then most likely we start seeing this formation of the W. But we need to actually see this N pattern first. When we get the second bottom and it starts bouncing off of there, making this the fourth piece of the leg, then we can get ready to make a trade. We can start interpreting. But until all that happens, there's nothing for us to look at. There's nothing for us to plan. There's nothing for us to do. So In the M formation, it's just the opposite. So a bullish bottom pattern is formed by two successive bottoms in price action, which typically forms a W, although at first it will resemble an upside down N, as we see here. The key lies in establishing bullish positions near the lower Bollinger Band with a target set to the upper Bollinger Band. However, if price continues to fall, it may be a strong sign to exit and search for a new opportunity. So what we're looking for is when it bounces off the second bottom, starts making this leg, is an opportunity to make a bullish trade with us expecting it to move towards the upper band. So this would give us our target price as well as an entry price. And we would use the moving average when the price bounced up and crossed the moving average. That would give you your entry signal. Your exit signal would come as price moves up and then isn't able to violate the and falls back below the moving average again. Or the reverse for the M formation. So a bearish top pattern is formed by two successive tops in price, which is opposite to the M with W to form an M. Before forming the entire M, an N will emerge in price action, and at this point, traders should want to get involved. When at a second peak and the N has been formed by the asset price action, it is time to establish a bearish position in trading. Should prices continue to rise afterwards, we might want to exit. So that's why we use the moving average crossover to make that entry decision. So we highly recommend combining Bollinger Bands with RSI. It's a perfect match. And there are two types of tops you want to know about. But if we combine it with RSI and volume, we then have ourselves a nice little trading system. So after a trend moves up and price fails to reach the outer band, as the uptrend becomes weaker, the signal is usually accompanied by an RSI divergence. During trends, the moving average holds very accurately, and a break above the moving average is usually a meaningful signal that the sentiment has shifted. So as we can see in this chart here, we see, just trying to get my marker on. We see price riding the bands up here. Okay, we got a buy signal at this point. When it bounced off the bottom, moved above the moving average, because when it's not able to violate the bands, the upper or the lower band, and it makes an attempt to stay down the lower band and that attempt is backed off, that tells you that we want to look for a position in the opposite direction. Okay. When we get that crossover of the moving average, we would enter a buy position. Now, as the price moved up here, here, and here, what we see is we see the bands in each price staying close to that outer band. Then we see the price attempt to reach that outer band, but is unable to. And then the next price falls down and is not able to come near that outer band again. When it breaks that moving average, that's an exit point for this long trade. Or it could be considered an entry point for a short. Now, while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or downside, it's important to use the bands to also set risk conditions, not just entry points. Additional risk reward should be set based on the width of the bands. The wider the bands, the more risk reward, because the more volatile the market is. With narrower risk rewards during low volatility and wider risk rewards during high volatility. Now, in contrast to other indicators, the Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of trends and get a lot of important information. Now, I have given you a handout tonight. This handout is a general guideline Again, it's not trading advice, it's just to give you the highlights and the high points of how to apply and use Bollinger Band or a starting point for you then to test them and adjust them to your own trading strategy. Now, there are several things you need to pay attention to when it comes to using Bollinger Bands to analyze trend strength. During strong trends, price should stay close to the outer band. If price pulls away from the outer band as the trend continues, it shows fading momentum. Now, the outer band is either an upper band or a lower band. Repeated pushes into the outer band that don't actually reach the band show a lack of power. A break of the moving average is often the signal that the trend is ending. So as we can see here in the screenshot, we can see a whole story told on this Bollinger Band through that whole trading of this asset. But the fact is, looking back an hour, looking back 2 hours, looking back 3 hours, doesn't help you trade moving forward. So moving forward at the wall, we always want to look for where the price action is in relationship to the upper or the lower band, and as well where it is in relationship to the moving average. So here on this little screenshot, we see in number one, price is strong in a strong downtrend, trades close to the outer bands at all times. Then in two, price fails to reach the outer band and then shoots up very quickly. And number three, we have three swing highs with lower highs each time and unable to break the band. So here we see one. This is called riding the bands, and it's ridden the bands down. And we see as here it's right on the bands. Now it's unable to reach those bands, tries again to attempt that violation or to reach those bands and is rejected. And that tells you this downtrend is most likely over. We then get a bounce above moving average, and that tells us we are moving into an uptrend. Here, as we go into the uptrend, we see price push up to make new highs, but then is unable to stay in those highs and actually falls below the moving average, moves back up, and still isn't able to reach that upper band, and then breaks that moving average again and moves into a very strong downtrend and rides those bands all the way down. So there's lots of stories to be told leading you up to where you are. But you all can, like I said, you can only make a trade at the window, at the wall. So you're all you actually really care about is not what happened 3 hours ago or last week, only what's happening now. Now, I'm going to pop up a video for you and let you watch a few-minute explanation of how to adapt and use some trading strategies with Bollinger Bands. And then we're going to discuss these in a second. So let me pop this up. Okay, so that gave, then you got to hear directly from the horse's mouth. That was John Bollinger, and he explained to you some uses for the Bollinger Bands that he developed. And like I said, you can go to his website at www.bollingerbands.com and learn all about Bollinger Bands and all the strategies to adapt them. But one of the most popular strategies out there is called the Bollinger Band squeeze. And the Bollinger Band squeeze is a straightforward strategy that is relatively simple to implement. First, look for securities with narrowing Bollinger Bands and low Bollinger Bands width. Bollinger Band width is the distance between the upper and the lower band. Ideally, Bollinger Band width should be near the low end of its 6-month range if you're looking for a long-term security, or 6 period or 6 days, whichever you try to develop for yourself. Second, wait for a band break to signal the start of a new move. An upside band break is bullish, while a downside band break is bearish. Note that the narrowing bands do not provide a directional clue. They simply infer that the volatility is contracting, and charters should be prepared for volatility expansion, which means a directional move. So in other words, as we see the bands contract, we're not looking at the price information side, we're looking at the bands contract, the width of the bands. Now we can get these by looking at the width of the bands or by using what's called percent B. And percent B calculates the width of the bands and is part of another indicator that drops on the bottom of your chart, which measures the width of the Bollinger Bands. But we can see this on the chart. So we can see as the band contracts, when the bands are contracting, it's telling us that we're going into a low volatility period and we should be getting ready for a higher or a jump in volatility. So you want to keep your eyes on the band. As the band narrows, okay, and the band width declines to a low end of its range, then we want to be prepared. And in this case, as the price is moving down the band, breaking below the moving average, you see price plunge to the lower end of the band. This would have given us a very strong sell signal. So even though the Bollinger Band squeeze is straightforward, charters should use at least combine this strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can confirm a break below the lower band. Unconfirmed band breaks are subject to failure. So because the Bollinger Band squeeze does not provide any directional clues, chartists must use other aspects of technical analysis to anticipate or confirm a directional break. In addition to basic chart analysis, chartists can also apply complementary indicators to look for signals of buying and selling pressure to consolidate. Momentum oscillators and moving averages are of little value during a consolidation period because these indicators simply flatten along price action. So when you see the bands contract, what you're actually doing is moving into a price consolidation area with low volatility. So instead, charters should consider using volume-based indicators, such as ADL, Chaikin money flow or money flow index, or on-balance volume. Signs of accumulation increase and the chance of an upside break, while signs for distribution increase and chances of a downside break, or simple volume. So as you can see, the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buyer and seller balances, and about potential trend shifts. Together with the moving average and RSI, Bollinger Bands makes a great foundation for any trading strategy. Now, there are many different Bollinger Band strategies, and I've covered a lot of these for you on your handout. There's many ways to trade using Bollinger Bands, but not Bollinger Bands alone. Bollinger Bands is more about providing you information about price movement and should be used with other indicators. But it's a great start because the other thing about Bollinger Band, it keeps your eye on price action. Because as I said before, most indicators are dropped underneath the chart. And traders tend to get lost in those indicators without paying attention to where price is actually moving. With Bollinger Bands, actually, let me pop up some charts and show you some active charts right now with Bollinger Bands on them. So we looked at the gold chart just to set it up, but here's an oil chart that's fully done with Bollinger Bands on it, and we can see the combination of RSI, MACD, DMI here. We can see the patterns on the chart. We can see how price is moving along the trend line. We can see how the bands are moving along well and what the prediction is, because see what we see. Let me just highlight this for you. The bands moved up to the upper band and were unable to sustain it, got pushed back down and then fell. And at this point, they fell below their moving average, which is the moving average line right here. And therefore, we're expecting a break down. Okay. We also got this break where it was unable to sustain that right at a resistance level. So now we're predicting a fall down to the next major support level for oil. So this is one way to use Bollinger Bands in your trading strategy. Then this is gold US dollar here. And here again, RSI, MACD, DMI, and we have the Bollinger Bands drawn on the chart. We see prices well underneath the moving average line, which is right here. Let me highlight that for you. So we see price moving down. We have our moving average, which is up here. Price rolled the bands down. We're unable to stay in a push back up, didn't break the moving average, and continue back, moving back down to that downtrend again that we've highlighted here again. But then once again have bounced off that lower band and are moving back up at this point. We also got a recent divergence with two of our major indicators. So we're looking for or predicting gold to move upward, and we could project that to move upward to the upper band, but we still don't know for sure until we see a very strong break of the moving average and price movement above. But these are ways that you can incorporate Bollinger Bands into your overall trading decision and trading strategies. So on that note, I'm going to say goodnight to everybody. Hopefully you'll find that handout I gave you helpful. The only place to get it is in a live webinar. You'll be unable to ask for it or contact customer support because it's only given out during this class. So make sure you download that PDF right now. And have a very good night, and we'll talk to you again. Good night now.